We are ready to start right now, and let me just introduce myself a little bit. So, once again, I'd like to welcome you on our first educational webinar. Webinar name is Basics of Forex Trading. My name is Yuri Safrono. I'm A to Z Markets Chief Currency Strategist and the person behind the daily free Forex signals on A to Z Markets. I have a PhD degree in finance and I work as independent equity manager. I have extensive experience in trading stocks, crypto, and Forex since 2009. First of all, I'd like to tell you that the webinar is sponsored by Forex4you, and let me briefly introduce you the company. So eGlobal offers two main services: online trading on more than 150 instruments under the brand name of Forex4you, and copy trading investing services under the brand name Share4you. Also, before we start the webinar, let me briefly mention the disclaimer. Any opinions made may be personal to the author and may not reflect the opinions of Forex4you. All expressions of opinions are subject to change without notice. This material is considered a marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer or solicitation for any transaction in financial instruments. Forex4you makes no representation and assumes no liability as to the accuracy or completeness of the information provided, nor any loss arising from any investment based on a recommendation, forecast, or other information supplied by an employee of Forex4you, a third party, or otherwise. All right. Let's finally start the educational part of the webinar. And the first question is, what is actually Forex? The Forex exchange market is the place where currencies are traded. Currencies are important to most people around the world, whether they realize it or not, because currencies need to be exchanged in order to conduct foreign trade and business. If you are living in Thailand and want to buy chocolate from Swiss, either you or a company that you buy the chocolate from has to pay the Swiss for the chocolate in Euro in CHF, the Swiss francs. This means that the Thai importer will convert the equivalent value into Swiss francs. The same goes for traveling. A Spanish tourist in China can't pay in euros to see the Great Wall because it's not a locally accepted currency. As such, the tourist has to exchange euros to local currency, in this case, the Chinese yuans, at the current exchange rate. Okay. Um, so what is actually Forex? The need to exchange currencies is the primary reason why Forex market is the largest, the most liquid financial market in the world. It dwarfs other markets in size, even the stock market with an average traded volume of around 5 trillion euro per day. The total volume changes all the time, so there is no exact figure. One unique aspect of the international market is that there is no central marketplace for foreign exchange. Rather, currency traded is conducted electronically over the counter, which means that all transactions occur via computer networks between traders around the world, rather than on one centralized exchange. The market is open 24 hours a day, 5.5 days a week, and currencies are traded worldwide in the major financial centers of London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, Sydney, across almost every time zone. This means that when the trading day in the US ends, the The foreign market begins to work in Tokyo and Hong Kong. As such, the Forex market can be extremely active any time of the day, with price quote changing constantly. So once again, Forex market is the largest financial market in the world, trading around 5 trillion each day. Trading in the Forex is not done at one central location, but is considered between participants by phone and electronic communications like computers. Various markets who are meeting currency for inter-global businesses. Central banks have particularly relied on foreign exchange markets since 1971, when fixed currency created to because of gold standard was dropped. Since that time, most international currencies rather than tied to the economic and political instability and infinite other perpetual changes also affect the currency market. There are countries open market and keeping a relative value compared to other world currencies. Businesses that operate in countries seek to mitigate the risks of doing business in foreign markets and hedge currency risks. Businesses enter into currency swaps to hedge risks, which gives them the right, but not necessarily the obligation to buy a set amount of foreign currency for a set price in another currency at a date in the future. They are limiting their exposure to large fluctuations in currency valuation. So the ability is due in part to different international time zones conducted over a network of computers rather than any other physical exchange that closes at a particular time. For instance, when you hear that the US dollar closed at certain rate, it simply means that was the rate at market close in New York. This is because currency continues to be traded around the world long after New York close, unlike such as domestic stocks, bonds, and commodities are not as relevant or international, and those are not required to trade beyond the standard business day in the issuer home's country. The demand for the trade in those markets is not high enough to justify opening 24 hours due the focus of the domestic market, meaning that it's likely that few shares would be traded at 3 a.m. in the US. Question is, how does Forex market work? The Forex market can be split in three main regions: Australia and Asia, Europe and America. For example, Europe is comprised of major financial centers such as London, Frankfurt, Paris, and certain in each of those markets. Each day of forex trading starts with the opening of Australia-Asia area, followed by Europe and then North America. As one region's market closes, another opens. or has already opened and continues to trade in the Forex market. These markets will often overlap for a few hours, providing some of the most active period for Forex trading. So, for example, if a Forex trader in Australia wakes up at 3 a.m. and wants to trade currency, they will be unable to do so. The Forex dealers located in Australia, but they can make many trades as they want throughout European or institutional trade and global businesses, and therefore requires a 24-hour market to satisfy the need for transaction across various time zones. In some, it's safe to assume that there is a very high risk that the participant in the Forex market will not currency trade. All right. Mm. This is really weird. It seems to be that the technical difficulties we had are not simply removed. So what I'm going to do is I'm going to ask you one more time to type yes in the question section if you can hear me properly. Uh, Guys, if you can hear me, type yes, plus, or something like that. I really hope that it's going to work. And right now the connection would be better. Um, okay. Uh, Different people comment different things. Some people complain that I'm breaking up. Some people say that the sound quality is perfect. This is strange, but I really hope that the connection improves. And there are some technical issues with the platform we're doing webinar on. So I apologize for that, and I hope that the quality would be improved next time. But for now on, we need to move forward. And I'm really sorry if for some people I'm breaking up. Let's go to the next slide. If guys, there are any issues with the sound, please feel free to comment in the question section and I will try to do something to improve it. All right. So the next slide is called What Moves Currencies. The foreign exchange market is comprised of currencies from nations all over the world. Given the unique and complex nature of each and every economy around the globe, it's an impossible task to identify all the factors that drive currency prices. However, the factors that are we're going to be discussing right now. And so the first one on this slide is economic releases. First, an oversimplified concept that is important to understand is that capital flows into economies that are considered safe, stable, and growing. Economic releases can be thought of as real-time reports and give investors a glimpse into the underlying performance of nation's economy. These reports are actually published periodically by governmental agencies or private organizations, Although there are numerous policies and factors that can affect a country's performance, the factors that are directly measurable and included the economic reports. Okay. All right. Yeah, the people say that the quality of the sound was improved, and I'm really hope it's gonna stay like that. Having a strong understanding of economic events allow investors to compare one country's performance against others around the globe. Before we jump into some examples of specific releases, it's important to know that there are many economic calendars made freely available online to track the release of the economic announcement. Let me just jump on the next slide with the Forex4you economic calendar. This is basically an economic calendar you can see on Forex4you website. It's prepared on a daily basis, and all the news on the coming day and basically the coming week is published here. And you can take a look on the forex4you.com/economic calendar. Take a look at this because it's very important to keep track of the important events, of the important economic announcements, which are published on daily basis. So many even highlight announcements based on their likelihood that they will impact the exchange rate. Here are some of the most common economic releases that investors pay attention to. Okay, let's jump back. The gross domestic product, GDP. GDP is a report that outlines the monetary value of all the finished goods and services produced within a country during a specific time period. GDP is one of the most watched metrics in forex trading because it's a clear indicator as to whether the economy is growing or shrinking and how much is changing relative to the opinions of analysts. The next one is non-farm payrolls. Non-farm payrolls figures refer to any job in the economy with the exception of farm work and other situations such as those employed with the military and intelligence agencies. This release holds such influence because it provides a gauge for investors to determine whether corporations are hiring. When reports suggest that non-farm payrolls are improving and strong, it can be interpreted to mean that the companies are growing, that newly hired employees have money to spend, which is in turn fuel broad economic growth. Growing workforces and a strong economy will often lead to a strengthening currency. The next one is retail sales. The retail sales is a very closely watched report that measures the total receipts of dollar value of all merchandise sold in retail stores in a given country. The report estimates the total merchandise sold by taking sample data from retailers across the current country. Uh, because consumers represent more than two-thirds of the economy, this report is very useful for traders to gauge the direction of the economy. Also, because that report's data is based on the previous month's sales, it is timely indicator, unlike GDP report, which is lagging indicator. This content is the retail sales report can cause above normal volatility in the market. And information in this report can also be used to gauge inflationary pressures that affect Fed rates. The next one is industrial production. The industrial production report, released monthly by the Federal Reserve report on the changes in the production of factories, mines, and utilities in the U.S. One of the closely watched measures included in this report is capacity utilization ratio, which estimates the level of production activity in the economy. It is preferable for a country to see increasing values of production and capacity utilization at high levels. Typically, capacity utilization is the range of 40 to 45% is considered tight and can increase the likelihood of price increases or supply shortages in the near term. Levels below 80% are usually interpreted as showing slack in the economy, which might increase the likelihood of a recession. Purchasing Managers' Index, or PMI, is derived from reports from purchasing from a variety of corporations across the manufacturing sector. The PMI figure is calculated based on five major indicators: new orders, inventory levels, production, supply derivatives, and employment. The primary purpose of this indicator is to provide investors with a snapshot of the state of the manufacturing sector and whether it's expanding or contracting. Other major common economic releases include Consumer Price Index, retail sales, durable goods, and unemployment. And I can speak like hours about those indicators, but what you need to know right now is that those indicators influence the volatility of the currency and influence the currency rate. And that's why in order to trade profitably on Forex, you have to monitor those news and you have to make conclusions out of the parameters which you see from those economic indications. All right, that's not all. There are several more and very important ones. I'm going to be speaking about them really quick, but I think it's going to be interesting. These economic releases are not the only factors to watch. There are also several meetings around these events that provide quotes and commentary, which can affect markets just as much as any report. Those meetings are often called to discuss interest rates, inflation, and other issues that affect currency volatility. Even changes in wording when addressing certain issues, such as comments from the Chair of Federal Reserve on interest rates, for example, can cause market volatility. The stock market is often regarded as the barometer of the current country's economic performance. Strong stock markets are often indicators of strong and growing economies, which in turn leads to increased foreign investment and demand on the currency. The performance of major global financial markets is a key indicator used by Forex traders. So you as a Forex trader should also keep track of the stock markets, not just every stock on the stock market, but the major indexes of the stock markets around the globe. So the international trade or a balance of trade. Um, the interconnections of the global economy means that the status of international trade is a key indicator of the economy's complete advantage. The balance of trade, or the difference between a country imports and exports, is a common metric used in conjunction with other data points by Forex traders for determining a country's economic health. In general, investors get concerned when a country's imports are larger than exports, known as a trade deficit, over a prolonged period of time. Persistent trade deficits are closely watched because they can put the nations at risk or future currencies devaluations. At this stage, the important thing to understand is that data points about the balance of trade and/or the state of international trade in general are commonly used in conjunction with other economic data to determine a nation's economic health. So the difference of interest rates. Varying interest rates among lenders in different nations is one and the primary driver of currency prices. The concept is discussed in more detail. Um, we're going to be discussing it a bit later, but it's a good to understand that generally speaking, foreign capital tends to flow towards high interest rates, which in turn causes exchange rates to rise. Politics. Forex traders try to stay as informed of political news and events as possible. Factors such as newly elected leaders, changes in fiscal or monetary policy decisions, and overall openness or to trade and commerce impact the performance of a nation's economy and therefore its currency. One example that is worth nothing is Brexit, which was the vote of a planned withdrawal of the United Kingdom from the European Union, which sent the British pound to a multi-decade low due to uncertainty surrounding the UK's economic prospects. While this is a drastic example of the impact of policies can have on currencies, sometimes even comments from nation leaders or hints of an upcoming market can trigger large price swings. Regarding Brexit, lately there are several news, and you can basically see on the British pound chart that if Theresa May, the British Prime Minister, says that we have a solution for the Brexit and we are ready to sign the agreement, the British pound rises. The very next day, the European authorities say that no, we're not going to negotiate anymore, and you have to adopt the agreement which we achieved, or it's going to be Brexit without the deal. And the very next day, the British pound drops. So those political events and the comments from politicians in the economic sphere, not only economic but political as well, they influence currencies very, very much. So understanding the factors that move currencies is an important first step to becoming a successful Forex trader. Simply following global news and events, reading analyst report, examining reliable commentary, and analyzing chart patterns can help Forex fundamental analysts gain a better understanding of long-term market trends and allow short-term traders to profit from an extraordinary happening. If you choose to follow a fundamental strategy, be sure to keep a calendar that highlights important dates so you know what these reports are released. Your broker may also provide a real-time access to such information, like Forex4you does. You can basically see the economic calendar and also news in the MetaTrader 4 as well. So let's dig a little bit deeper into the basics of Forex. And now we're going to be discussing what a currency pair is. So in Forex markets, currency trading is conducted most frequently among the US dollar, the Japanese yen, the euro, and the British pound, as well as the Canadian dollar. The currency pairs such as Euro-USD, for example, represents the relationship between the euro and the US dollar. The first currency is the base currency, and the second currency is the quote currency. So to buy Euro-USD at 112 on a trade for 100,000 currency units, you would need to pay 112,000 euros. I mean dollars for 100,000 euros. Uh, Four major currency pairs are the most traded and have the highest volume. These are known as majors. They are Euro-USD, Euro-dollar, USD-JPY as a dollar, yen, pound USD, British pound dollar, and the USD CHF or United States dollar versus Swiss franc. These pairs contain the US dollar. Uh, Let me just jump to the next slide, the Japanese yen, um, as a base currency. In in this pair, in yen-denominated currency pair, a pip is only two decimal plates, or yeah, you see that 0.01. This is 1/100th of a cent. Currencies are often traded in lots that are 100 units of underlying currency. Yep, one lot, 100,000. I'm sorry. So the next slide is what pips is. A pip, an acronym for price interest point, is the tool of measurement relative to the smallest price movement made by the exchange rate. Currencies are usually quoted to four decimal prices, meaning that the smallest large change in the currency pair would be in the last digit. These would make one pip equal to 1/100th of a percent, or 1 basis point. For example, if a currency price we quoted earlier changed from 1/12 to 1.1205, this would be a change of 5 pips. To get the value of one pip of a currency, an investor has to divide one pip in decimal form by the current exchange rate and then multiply the number by the total amount to trade. Keeping with earlier example of Euro-USD currency pair, let's say that value of one pip is 8.93 euros. We divide it. You basically can see a formula on your screen. To convert the value of one pip in dollars, you just multiply the value of one pip by the exchange rate. So the value would be like that. It's $10. The value of one pip is always different between currency pairs because the differences between the exchange rates of various currencies, a phenomenon, does occur when the US dollar is quoted as the quote currency. When this is the case for no total amount of 100,000 currency units, the value of one pip is always equal to $10 in Euro USD. So what does leverage mean? What is leverage? Leverage results from using borrowed capital as a funding source when investing to expand the firm's asset base and generate returns on risk capital. Leverage is an investment strategy of using borrowed money, especially the use of various financial instruments or borrowed capital to increase the potential return of the investment. Leverage can also refer to the amount of debt a firm uses to finance assets. When one refers to a company, proprietary, or investment as highly leveraged, it means that the item has more debt than equity. Investors who are not comfortable using leverage directly have a variety of ways to access leverage indirectly. They can invest in companies that use leverage in the normal course of their business to finance and expand operations without increasing their overlay. So the example of leverage, let's say you see it on your screens. Let's imagine a company formed from an investment of $5 million. The equity of the company is those $5 million. This is the money the company can use to operate. If company uses debt financing by borrowing 20 million, it now has 25 billion to invest in business operations and more opportunity to increase value in shareholders. An automaker, for example, could borrow money to build a new factory. The new factory would enable the automaker to increase the number of cars it produces to increase profits. So the downside of leverage. A leverage is multi-faced complex tool. The theory sounds great, and in reality, the use of leverage can be profitable, but the revenue is reverse is also true. Leverage is magnifies both gains and losses. If an investor uses leverage to make an investment and the investment moves against the investor, he or she loss is much greater than it would have been if he or she had not leveraged the investment in the business. Where a company can use leverage to generate shareholder wealth, but if it fails to do so, the interest expense and credit risk of default destroy shareholder value. So basically, what you need to understand is when you are using leverage, both your profits and losses are magnified. All right. So you have to carefully use leverage, and if market against you, you have moves against you, you have to always remember that using leverage can as well as bring you more profits as well give you more loss, right? So the next question is basically how to open a trading account. Let me show you how to open a trading account on Forex4you website. So there we go. All right. So you can either choose a demo account or a real trading account. So to open a demo account, you click on trading. You basically not click, but put your mouse on it and then click open demo account. All right. Then you can see the form. You click on here, and then you fill all the information, including your phone number, password, first name, last name, email, and the country as well. All right. To open a real trading account, which allows you to trade with real funds on mobile app, standard MT4 platform, and Forex4you desktop trader, you simply click trading, and then you can choose several types of the accounts. If you are interested in the differences between those accounts, there is the exact descriptions of what the conditions of trading on each account is. And when you decided which account you need to open, you click on this button. Yeah, and you go to the very same registration page where you fill all the data, including your email. And after that, you would receive an email from Forex4you on your email with your login and password for MT4 and as well password to log into the client's area. So yes, in this confirmation email, after you receive it, you can log into Forex4you members area, but you would see that the account is not validated yet. You can log into MT4, but you would not be able to trade until your account is validated. Now, to validate your account, you would need to provide a Forex4you necessary documents, and the exact documents are listed in your personal area on the website. So if you have any questions about the accounts with Forex4you and about the brokerage company, you can ask it in the end of the webinar. So there are two ways to approach Forex trading. The first one is called technical analysis, and the other one is called fundamental analysis. Um, so basically, technical analysis comes in the form of both mutual and automated system. So a mutual manual system typically means a trader is analyzing technical indicators and interpreting the data into buy or sell decisions. An automated trading analysis means that a trader is teaching the software to look for certain signals and interpret them into executing buy or sell decisions by itself. When automated analysis could have an advantage over its manual counterpart, this is that and interpreted to take the behavioral economics of the trading decisions. Forex systems use the past price movements to determine where a given currency may be headed. Even the scale of the forex market is quite common for investors to use charts and the various tools of technical analysis as the basis of making buy and sell decisions. More specifically, given a liquidity for of the market and broad number of fundamental factors that influence prices. It is warranted to assume that all salient data is already priced into exchange rates. We'll take a closer look at some specific chart patterns and indicators later on, but at this point, it's important to understand that since so many rely on the charts, that common signals can be enough to trigger moves in an underlying currency. So the fundamental analysis is often used to analyze changes in the forex market by monitoring figures such as interest rates, unemployment rates, gross domestic products, and other types of economic data that come out of countries. Now, for example, a trader conducting a fundamental analysis of pound USD would find information on the interest rates in the UK very useful, as well as the US. Those trades would also want to be on top of any significant news releases coming out of the UK and the US to gauge the relation or to health of their economies. And so among the pros of trading Forex, I'd like to mention the following. Low costs. The Forex trading can have very low costs, the brokerage and commissions. There are no commissions in real sense. Most Forex brokers like Forex4you makes profits from the spreads between Forex currencies. Compare that to equity or other securities trading, where the brokerage structure varies widely on a trader must take such fees into account. The Forex trading suits varying trading styles. Like the Forex market runs all day, enabling trades at one's convenience, which is very advantageous to short-term traders who tend to take positions over short durations, say a few minutes or a few hours, offers very high liquidity. Compared with any other financial markets, the Forex market has the largest number of market participants. This provides highest level of liquidity, which means even large orders of currency trades are easily filled efficiently without any large price deviations. These eliminate the possibility of price manipulations and price anomalies, thereby enabling tighter spreads that lead to more efficient prices. No central bank exchange. Being an over-the-counter market operating across the globe, there is no central exchange or regulator with the Forex market. various currencies, central banks occasionally interfere as needed, but there are rare events occurring under extreme conditions. Most such developments are already perceived and priced into the market. Such a decentralized and deregulated market helps avoid any sudden surprises. So volatility, it's a trader friend. The major currencies frequently display high price swings. If traders are placed wisely, high volatility assists in enormous profit-making opportunities. So there are 28 major currencies pairs evolving, eight major currencies. So out of eight major currencies, there are 28 pairs. So there is a better variety of tools to trade on Forex. Low capital requirements. This is also a very nice pros. Due to tight spreads in terms of pips, one can easily start Forex trading with a small amount of initial capital. Without more capital, it may not be possible to trade in other markets like equity, futures, or options. Ease. There are hundreds of Forex technical indicators to draw on short-term trades and several fundamental analysis theories above for long-term Forex trading created enormous choice of traders with varying levels of experience to make a swift entry into Forex trading. Now let's jump to cons as well. Each medal has pros, both sides. One side is pros, another side is cons. So Forex has cons as well. And the first one is lack of transparency. Due to the deregulative nature of Forex market dominated by brokers, one actually trades against professionals. Being broker driven means that the Forex market may not be fully transparent. A trader may not have any control of how his trade order gets fulfilled, may don't get the best price, or may get limited views on trading quotes as provided only by his selected broker. A simple solution is to deal only with regulated brokers who fall within preview of broker regulations. Uh, to be said, such broker is Forex4you. It's a regulated broker. The market may not be under the control of the regulators, but the activities of the brokers are. The next one is complex price determination process. So Forex trades are influenced by multiple factors, primarily global politics or economics that can be difficult to analyze information and draw reliable conclusions to trade on. Most Forex trading happens on technical indicators, which is the primary reason for the high volatility in Forex markets. Getting the technicals wrong may result in a loss. High risk and high leverage. So, high risk with no control over macroeconomics and geopolitical developments, uh, one can easily suffer huge losses in the highly volatile Forex market. If things go wrong with the particular currency pair, um, so a management or like the politicians can initiate the required changes, and they can alternatively approach regulations. So Forex traders have nowhere to go. There is, like, let's say, no like central Forex commission or something like that, um, where a Forex trader can go and file a complaint. And high leverage, as I said, it's not just a con, it's a pros and a con in one. So you can, from a high leverage, you can make more money with the help of the leverage, and as well, you can lose a lot of money with the help of the leverage, as you know. All right. Okay. So far, so good. We have finished the educational part of our webinar, and now I'll be happy to answer your questions. So the questions can be typed in the question section, and feel free to ask anything you want. Okay. The question is, how much money do I need to trade Forex? Um, Basically, if we jump to Forex4you website, let me open it to you. So the cent account, you see the minimum deposit is basically zero. So the minimum amount traded is 001 lot. If yeah, the minimum amount is zero, it's a little bit like trick. You can deposit $1, you can deposit $2, but let's calculate the necessary amount of money which you need to owe as equity to open the smallest trade they have. So basically, the cent account is 0.1 lot. But because it's a cent account, not a real account, the contract size is not a usual size like 100,000, but 1,000. All right. So you need to open a 1.1 lot. So and the lot is 1,000. So basically, without leverage, if you are not using any leverage, in order to open a minimum position of 0.01 lot, you have to owe $10 on your account. It's $10. If you trading with leverage, it says 1 to 1,000. But I would not recommend you use a lot of leverage. But let's say you're using 1 to 110 leverage. So it's 1 to 6 to 10 leverage. Yes. So in this case, no, let's say no leverage. You know, let me jump to the PowerPoint. It would be better because this Word file is kind of, so let me jump to the PowerPoint. I'll create a new slide. Right. Uh, Something is wrong. So we're speaking about cent account, where one lot is 1,000. All right. So the minimum amount you can trade is 0.1 lot, and you need $10 with no leverage. That's how it works. If you're using 1.10 leverage, you basically need 10 times less money to open the same trade. So in this case, you need to $1 to open the trade of 0.1 lot on cent account. Okay. If you're using 1.100 leverage, which I would not recommend, obviously, but let's imagine, okay, in here, 1 to 100 leverage, you basically need to have on your account 10 cents. This is the approach which you use. If it's a real account, yes, in a real account, classic, let's say, classic account, one lot is a standard size of $100,000. So in this case, one lot you need to owe without leverage. You need to have 100,000 with no leverage. With 110 leverage, it becomes $100, and with 1 to 100 leverage, it basically becomes $10. So it's for a classic account. That's the minimum amount you need to have on your account in order to open trades. But if you're just asking of how much do I need to have on my account minimally to go into, open the minimum positions and so on. You can basically start from the demo account and see how much for yourself it is comfortable to trade with. Like if you are comfortable to lose $100, yes, you can deposit those $100 and try to make money out of it. If you are comfortable with losing more, you can deposit more, but it all depends on your life situation. But regarding minimums, on this slide you can basically see the minimums which you need to open minimum trades. So if it was your question, if I answered your questions, then okay. If not, you can comment and I'll try to express my views a little bit more. So the next question, the view on Euro USD for the next week. All right, hey guys, next Monday, let me just see the date. The date is 11th of March. On Monday, we have a live market analysis webinar. I would analyze pretty much every major pair on Forex, and I would basically for sure analyze Euro USD there. And we're going to be discussing it for like 10-15 minutes, only this pair. On the history and on the future, we're going to see the political events, economic calendar, and we're going to draw charts. It's going to be on Monday, so I encourage you to visit the webinar on March 11th, same time, live market analysis. Okay. Is there no central marketplace then who handles the conflicts made protocols? All right, basically, you can see that on Forex, there is no central exchange, but there are different authorities. Like let's say in Great Britain, it's FCA, it's called. Let me maybe open the FCA. FCA, yeah, I'm gonna be showing you the website regulator. Yes, there it is. Like FCA is the Financial Conduct Authority, and any brokerage company which is regulated by this association and operates in the Great Britain falls under the laws of this association. And in case you have any issues with the brokerage company which operates under, let me see, under FCA regulation, it means that you can basically file a complaint in this organization. Yeah, but regarding let's say in Russia, there are several agencies which also regulate. In Cyprus, it's CySec. It's called CySec. The Cyprus Securities and Exchange Commission. So it regulates all the brokerage companies which operate on Cyprus, and this way, you have to, when choosing a broker, you have to take a look if the broker is regulated, which authorities it's fall under, and who you're gonna file a complaint to if some situation occurs. Because there are so many Forex brokerage companies which are not regulated at all. Let's say they list themselves in some unregulated country where there is no such association which does regulation, and they operate as they want. And if you have any problem with this broker, you have nowhere to go, basically nowhere to go, because on their website it would say that you have to, let's say, go to the court of some Cayman Island somewhere in Atlantic. for sure you're not going to fly to Cayman Islands and file a complaint and go to court. So that's why you have to choose the brokerage companies which are regulated and which fall under normal regulations for your own sake. If leverage is one, the next question is if leverage is 1 to 100 and I'm operating with $1,000 deposit, put it all in and prices grow down instead of going up as I would like, let's say down by 5%, how much do I lose from my $100? All right, let me try to explain it to you, but what you need to understand is that it depends on whether you are trading with leverage or without leverage. As you said, let's imagine that you have $1,000. You're using a classic account where lot size is standard size. Let's do it this way. So you're trading with 1 to 100 leverage. All right. So the leverage is 1 to 100. We jump here. You have $1,000 deposit. All right. So in order to one pip in this case, one pip would be evaluated like $10. One pip value is $10 in this case. If you're using 100 leverage. So that means that let's say 113.00 you are buying, okay, but it goes against you. Each pip, one pip, is if your all your deposit is $100 divided by $10, which is the amount of one pip. You can basically see how many pips you can lose until there is zero on your account. So it's 100 pips. If you lose 100 pips, your deposit is burned, like you have nothing. So if you bought it on 113, that it's gonna grow, and the rate became 1.1200. All right, it's 100 pips difference. Current rate. That's it. Current. That's it. Your deposit would become zero. So if you're using 1 to 100 leverage, it will be burned when the rate would become 1 to 1. Or let's say if you're selling, if it goes to 1.14, the current rate, your deposit would be zero. You would lose everything. So please don't use such huge leverage as 1 to 100. If you use less leverage, let's say 1 to 10 leverage, one pip is $1, then your deposit can hold 100 pips. So if you, let's say, selling on 113, you would lose all your money only if the rate becomes 123. Buying, you would lose everything only if the rate becomes 1.03, like that. So please don't use very high leverage. Okay. All right. Answer, please. Yes, I believe I answered. Okay. That it is different from the country to country. What is the? All right. Yes. Regarding the, I was like, what is the commission which regulates brokers in India? Guys, I have to admit, I have not traded with any brokerage company from India, and I do not know what commission or authority regulates brokerage companies in India. All right. I do live in Belarus, and in Belarus, all forex broker companies are regulated by the national bank, the central bank of the country, and so it's very strict regulation. They have to hold deposits in local accounts. They have to, uh, submit a lot of forms, and there is a very strict regulation. I know that there is a good regulation in UK. It's very good regulation in the United States, also in Europe as well. But I cannot answer this question regarding Indian forex brokers. Okay. All right. There are comments from one of the listeners that trading in India is legal but limited. All right, but I cannot comment on that because I'm not familiar with Indian forex brokers. One also question, what is a zero point 0.0 lot? Once again, on the classic account, they're on Forex, you don't trade with dollars or like what you buy or sell is lots. And one classical lot is $100,000, which means that if you're gonna be buying one lot of a currency, you are buying $100,000. But the brokerage companies like Forex4you, they allow you to trade with smaller lots. So probably I can jump to the website once again. No, I believe I have it somewhere, but oh, okay, there it is. So yes, if we go here, so you see that the amount of lots you can trade, the minimum trading volume is 0.1 lot. That means that you are not obliged to buy one lot, like $100,000. You can buy one lot, which is $100. So instead of buying $100,000, you can buy $100 or $200 or $500, for 5,000, I mean. So they allow you to trade with smaller sizes than the standard Forex lot. So, but the lot is kind of a description of the amount which you want to trade on your Forex account. All right. All right. Do we have any other questions? I think not. All right, there are no more questions, guys. I'm gonna be waiting for like 1 more minute for you to submit any questions if you have. Uh, let's see. If you don't have any questions, so I'm gonna be thanking you for visiting this webinar. I hope it was beneficial for you, and I hope you enjoyed this 1 hour, actually 1 hour and 25 minutes with me. And I would like to tell you that we have a series of webinars. This is one of the 5 educational webinars we're gonna have, same time, same day, and also on Mondays we're gonna hold 5 live analysis webinars. That's for the person who was asking about the Euro USD live analysis. It's gonna be on Monday, same time. Uh, and I encourage you to visit those webinars as well. So, how PEEP affect our return? One more question. So the PEEP is basically a measurement of the change of a currency. All right. So if, let's see, in this case, the classic account, like I said, one lot is $100,000. Let's assume that no leverage you're using, no leverage, no leverage. Yes. In this case, uh, you are trading with one lot, $100,000. You need to calculate the value of the pip. The value of the pip is calculated, I think, right here. Yes, yes. So the standard pip on EURUSD, if you are trading with one lot of any currency, is $10. So if currency is changing, like let's say in this case 113.78, and it changes 2 pips to 113.81, that means that the change of a currency is 2 pips. And in money, if you bought one lot with no leverage, you're gonna make 20 dollars profit or loss. Okay, so first, this is basically, you don't need to calculate pip value on daily basis, like before opening currency, but you have to see how much, basically, how do you open a trade? First of all, because of money management and risk management rules, you decide how much money you can afford to lose on any particular transaction. Let's say your deposit is $10,000, you are ready to lose not more than 2%. You're gonna go for 2% risk. That means you're gonna lose, maximum you're gonna lose is $200. So what you do is you calculate the amount of stop loss which you have, and then the amount of loss. If the if the position goes against you, the market goes against you, and you're gonna make a loss, it's not gonna exceed the amount of money which you can afford to lose, like those 2%. So yes. So, but the PEEP, once again, the question was how PEEP affect return. So basically, the PEEP is the measure of money on Forex. The change of the currency is in PEEPs, and the value of PEEPs when you open a position is converted into real money. So it directly affects. How we calculate $10 as 1 PEEP, which we, so that's the formula. That's very easy. One lot, like EURUSD PEEPs, that's how it's calculated. But basically, one lot is 100,000. Where was it? Like in here. It would be $10. All right. Are there any more questions? Okay, guys. I think there are no more questions. So that's, I'm gonna say thank you for visiting the webinar. I hope you to see. I hope to see you next Monday, same time, for a live analysis market webinar, um, which was sponsored by Forex4you and brought to you by Yuri Safrano, Chief Currency Analyst of A2ZMarkets.com. Thank you very much for visiting and hope to see you soon. Have a great weekend. Bye bye.